Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. This episode is the high-quality audio version of a Instagram live broadcast from yesterday, September 28th, 2021. We covered a lot of ground. We talked about everything from Ford versus Tesla, short-term versus long-term investing, the importance of learning vicariously from other investors' mistakes, reversion to the mean, Enron, risk, checklists, Howard Marks, and much more. If you haven't already, make sure you are following and subscribed to the podcast on Apple Podcasts or Spotify. Also, we have a YouTube channel I want to make sure you know about. The link is in the description. It's CMQ Investing on YouTube. But with all that said, let's get right to it. What's up, everybody? Just letting people hop in here. Feel free to the way these kind of go is people just drop in their questions, and I'm happy to answer anything. And if I don't have the answer, I'll just say that. And so we'll get Connor, the overconfident investor, to come answer. So here's the news I subscribe to. I subscribe to Barron's. I subscribe to Wall Street Journal, Bloomberg, Financial Times. Here we go. Barron's is very like, here's the stocks you need to buy. Like Barron's is very actionable, but the stock market is finally having its temper tantrum. It says global investors were worried over economic growth and inflation, sending bond yields higher and helping commodity prices hit decade highs. You know, something I don't really get is I don't really buy into the whole like time to buy growth or like time to buy value. I just find like that is something that is just done to keep people active. You know, like at the end of the day, if you're buying a big basket of growth or value, you know, you want to just find, if you're going to take that approach, just buy a great business and don't worry about if it's growth time or value time, because there's so many disadvantages to having to move in and out of positions, you know, in terms of, and as some of you have heard of us talk about this, I don't mind. I think we should continue to talk about it because we can stress test that idea and see if it's right or not. And I'm not trying to indoctrinate everybody. I see Freddie Hernandez 111 says, long-term, just keep adding dips on uptrend stocks. You know, and again, I'm not judging what you're doing, Freddie. I'm just, you know, this is what this is all about. What I would say in response to that would be just make sure that the stocks are not overpriced as is, because that's a great way, you know, if you're buying something that's been up, and it goes down a little bit, but it's still overvalued. If it does have a correction, that's going to be a tough one to kind of cope with, you know, from a emotional equilibrium standpoint. You know, you could end up kind of in a bind. But again, I don't know what you're buying the dip of, but I just know that's an easy mistake to make. You might hear some of my dogs are chowing down right now. They're stress eating because of the markets. They're like, oh, father, are we going to have food, father? Let's see what else we got going on here. I saw that Ford is building some sort of electric vehicle mega campus to compete with Tesla's gigafactories. And that's an interesting point because I don't know, you know, Ford's plans, but it's a good point about how, you know, whoever's the leader or the first to market, there's always going to be, you know, as soon as someone realizes there's money to make, there's going to be competition is going to show up. And that's why it's helped me really appreciate the moat concept on like a deeper level. Because if a company doesn't have a durable competitive advantage, inevitably, you know, they're going to get squeezed a little bit. I see some questions here. Let me make sure. The only Elysium says, "How would you market a luxury jewelry and watch a store?" This isn't from my professional expertise. This is investing, so I don't want to get into like how I would market stuff. That's why one of the reasons I wanted to keep my professional life separate from this. But no problem with you asking. By the way, I just don't want to like start to get into like, hey, let me give you my, because then I'll probably talk for 45 minutes because my mind flies on that stuff. Greg says, how do you find a good business? Could you share an example, something that you bought recently? So Greg, this is not a cop-out, but I worked really hard on this podcast in response to one of our listeners' questions about, you know, what are 5 indicators of a great business? And it's called, that's what it's called. It's like 5 characteristics of a great business. It's on Apple or Spotify. It's the person who requested it said he really liked it. So I can say confidently that it'd be a better response than what I would say right now. I mean, I can throw a couple ideas out, but I would recommend checking that out. Let me see if I can put it in here for you guys, so that way you don't have to go look for it. Something also, just while I'm looking this up, that helps a lot is if you start to ask yourself that question, like what would be, if you had a business, what would be use the inversion trick. So if you say, let's say you want to have a terrible business, like what are some of the characteristics of that business? And just think that through, because then, you'll start, sometimes if I just answer the question for you, it's not going to, I could be wrong, right? Like, so you could be operating off of what I said, but by the way, I don't think I'm wrong, but I also know there's always more to learn. So no problem, Greg. Let me see if I can paste this in here. This might work. Yes, it did. Boom. That's the Apple one. Let me know if you need Spotify. I can get you Spotify too. I've got a couple episodes that are close to the finish line, so we'll have some new episodes this week. Hoping to get one up today, and I'm recording this one so we can have another one of these lives that has the good quality audio. What's going on, everybody? I see some new people are joining us. Happy Tuesday. Let me just make sure I wave back to everybody. Greg says, what is your strategy in the current market scenario? I'm just sticking to the script. So, my whole game is long-term, trying to not be stupid, avoid the big catastrophes that a lot of investors fall for or fall into. Something I spend a little time on is trying to read up on all the big goofs that people make. I'm taking Charlie Munger and Warren Buffett's advice and learning vicariously. And by doing that, I'm knowing what to stay away from. Something I really enjoyed was learning the root causes of a lot of these big mistakes that people make. And to give you an example of that is, a lot of you have probably heard me say this, but overconfidence is a killer. And so our tendency to be overconfident in our own abilities, whether or not we're buying in and out of positions or typically, like the more active you are, that's correlated with poor long-term results, which I think is really interesting. And I think my own history would show that. I do own a few individual businesses, nothing that's that like crazy. Maybe a couple names maybe you haven't heard of, but I don't have like a huge position in them. It's more of just because I'm interested. Yeah, I'm trying to be as passive as I can because I'm, compound money quietly, just long term. That's how I want to get that snowball going. That's the game plan. So, and I think it's just I'm doing that because I'm trying to do what's the most rational. And I think that's something that has been, Charlie Munger has encouraged a lot, over the last several years. How many years, Greg asks, how many years is good for long-term strategy? 5 years, 10 years? Well, I would say if we use the, Charlie Munger example, I mean, depending on how old you are, I think, you want to, long-term could be 30, 40 years. Ideally, you could find a passive index fund and just park your money there, keep contributing, and, you have time arbitrage. I'd recommend pulling out a compound interest calculator, which not pulling one out like you have one on you, but there's some websites you can just, dial in the numbers and even assume a relatively conservative growth rate. Let's say you assume like 5%, and you're contributing whatever you say you're going to contribute per year. And depending on, what your technical age of retirement is, just do the math that way. And, you'd be amazed how those extra 5-10 years after the first 20 or 30, what kind of a difference that makes. But it also depends on what you're investing for, right? Like, I think that's why it's really hard to offer like a one size fits all. Again, not advice, let the record show this is not financial advice, but just thinking, when just trying to think through these scenarios, there's so much to consider, like people's risk tolerance, where they are in their life stage, and what they want to use the money for. Are you maxing out your existing IRA? Do you have a retirement account? That kind of stuff. I thought about maybe a good episode because someone asked this question would be like, my little guys are chowing down. Would be like, how would you invest $10,000 right now? Someone asked me that a few lives ago. And I think what I would say is I'd be like Spencer, I'd go VU. But I'd love to like further explain why that is, right? For like a long-term perspective. Greg asked me, what do you think about the Indian stock market? I don't know anything about it. And I don't admire, I think it's best that I just acknowledge that and admit that. I don't want you to I don't think I'm an expert on everything. I'm so used to like in my regular life, like non CMQ, I have an answer for everything, but this, I know nothing about the Indian stock market. I have some good friends who are from India, but I've just barely scratched the surface with them about the stock market there. Freddie asks, do you think Amazon is over volume for a long term? Over volume in the sense of like, do you just elaborate a little bit there? I mean, I think you have to look at it like in any scenario. Are you getting more than you pay for? Based on what you think the future earnings are going to be, based on your, evaluation of that business. I haven't looked at Amazon. I think I'm exposed to Amazon through some index funds, but I don't own Amazon individually. It's really interesting. I've been, talking about the Charlie Munger's mental models. Reversion to the mean is it's one of these big ideas that it really, really works. And, you look at like some of the companies that have these incredible runs, and this year they're kind of lagging. I'm not suggesting it's only that, but it's certainly like Cathie Wood's ETFs, for example, had like an incredible couple of years, and this year they're down a little bit. It's just the nature of things, right? Like as more people crowd into something, and there's this tendency that I keep reading about, and it's not like a new epiphany, but I feel like I've really tuned up my ability to discuss it, is the tendency for us as investors to look at past returns when we're buying into whatever we're buying into. It's just our nature. And by doing that, you're basically buying the past that doesn't exist anymore. So like if Cathie Wood's ETF did 150% over a 1 year period, that's people are, oh, it's up 150. Like, let me pile into that. And then as people pile into it, it almost forces reversion to the mean. Because first of all, everyone's looking at every move she makes. She can't be as nimble, she can't take as many small cap positions. And on top of that, it's just the nature of opportunities, right? Like as more people crowd in, I mean, the world doesn't work where, everyone can get in on something that everyone knows about and everyone's going to get this exceptional return, right? And that's something where like that logic is, I think Charlie Munger, probably brought to my attention at some point, where it's just like the world doesn't work like that. And I love that explanation for certain things where you can just kind of like, bat out what doesn't make sense. He'll do like just bat out the folly. A company that I've been sitting on for a long time, and I plan to continue to, is Apple. I mentioned I first bought Apple in 2014, and it's something where I can't say enough good things about that company. Like who's a threat to them competitively? And of course they have competitors, but just from the standpoint that, in the different spaces, or the different lines of business, they just have such a strong presence, strong market share. The brand is almost like impeccable. And I continue to be satisfied with every product they put out. I don't know about you all, but that doesn't mean you should buy the business or that it's priced right for you. But just in terms of how many great businesses are really out there, how many great investment opportunities are there at any one moment? There's not going to be that many. And I'm not saying Apple is the one to get into right now, because again, it's, you probably missed the boat, although I shouldn't say that because, it could have a nice run left. But as far as, what would be something now, what is going to be the Amazon in 10 years? That's very difficult to predict, but that's the question we should be trying to answer. That's the question worth answering, that if we could, narrow in and have a thesis there, that's something where, we would be ahead of the curve and be able to load up on something before everyone agrees. I think if you're going to go the individual route, or even if we're just doing it hypothetically, that's the way you want to think about it. And I'll share something that I've, because I've gone through all the Berkshire Hathaway transcripts. I'm totally like obsessive nerd on my quest for more quotes. But I think it was like all it takes is one. One sec, guys. I'm going to pull this up. But it's basically, I can talk about it without having to look at it. But both Warren Buffett and Charlie Munger have said in different senses, like, it really, to create a fortune, the fortunes of the country were not built on like a basket of stocks. They were built on someone loading up on one name. There were some fortunes that were made off Coca-Cola. There were fortunes that were made off Amazon. And that's the idea. Like, if you're not going to go, if you think you're a know something investor, you want to find one, maybe two, where you really know something, then load up. And that's been my experience outside of the investment world. For other things where, if you know something, you harvest while the sun's out, you concentrate your forces. It just makes more sense, but you have to really know, right? And I think the danger for us as investors is all the studies show, and I'm sure we can all relate to this. We tend to think we know when we don't know. I'm always learning new ideas, new concepts that make me go, wow, I was blind to this thing that I shouldn't have been blind to. And, but Charlie Munger has said he's not known anyone who's been able to get, great at investing with any sort of like speed. It's something that takes a long time. Even for Warren Buffett. I mean, Warren Buffett bought his first stock. What was he, like 11? The Wealth Game Changer says, hi, Chris. Hey, what's going on, Wealth Game Changer? Speaking of Wealth Game Changer, I owe you, or I want to get back to your email. I just want to write something a little bit more thoughtful, and I've just been totally bombarded with life and work, but I appreciated what you sent me. Have you ever tried to develop an investment-specific checklist using Charlie's The Psychology of Human Misjudgment talk? I have, and there's one, it's not the way I made mine, but in Poor Charlie's Almanac, there is, there's some of Charlie's checklists. And I think that's something that I will plan to, I've got some stuff for you on that. I made a guide to checklists a few months back that I'm just kind of reconfiguring how we're going to distribute this stuff. Because I have to focus on, I want to make the podcast the focus and everything. But there's, I do have a pretty interesting guide to checklists for investors, and I included some from a guy who was mentioned a lot in the Warren Buffett portfolio, Michael Maubausen. He's got some great checklists, and I also included details on like the origins of checklists, because going back to this idea of avoiding disasters, as investors, we want to avoid financial disasters. It's like we want to do things that are going to prevent mortality. And that's something that, when you look at where checklists originated, whether it's aviation, and then in the medical world, or like in surgery, and I'm like aviation and surgical, those are areas where literally like having checklists reduce death. And that's what we want to do with our own investments. Or as investors, we want to have tools in place or systems in place that keep us from making goofs. And the problem is what I've again, because it helps me to learn why something works to really start using it. Our human brains, we're just not as methodical as we think, and especially if you're tired, you're hungry, or you're had a long day, it's very easy for you to not follow a process. But Greg, I'm glad you brought that up. I'm going to screenshot this just so I can follow up with you on that. See what the what happened to the VU today? Just curious. Oh, it's a little dipper, big dipper. I'm like long-term investing. I'm like, gotta buy the dip. Young Behold says, love the content, pleasure to connect. What's going on, man? Nice to have you here. All right, let me pull up this news here. I'm trying to get caught up myself. I don't know enough about treasury yields. That's an area I really do not know very much about. And again, there's so much to learn. It's just like, that's an area I need to get a little more inundated with. Like, so these headlines, stocks sell off as treasury bond yields surge. I'm like, well, I mean, I could figure this out probably like in 5 minutes with us right now, but it's just, there's always so much more to learn. Yes, Charlie Munger, and I'm sorry I'm not saying your name right. Is it Rajan? Says Charlie Munger has always been underrated, but is now getting the attention he deserves. Absolutely. All right. What's this here? Yellen warns Congress of cash supply running out around October 18th. Oh, that's good news. That's great to see. Rajan says, I used to read books about Charlie Munger earlier, but I stopped doing that since I came across your page. You're my go-to guy for his content now. That's awesome, man. Thanks so much. Thanks for just telling me that. I mean, I obviously, you guys tell from the captions. I don't just like throw up the posts. I put a lot of thought into it, and that's awesome. Yeah, on Apple Podcasts, I'll put a link in here. I hate asking for stuff like that, but I realize that's the only way it's going to happen. Is you have to be a little bit of a nudge. So I appreciate it, guys. I mean, that's awesome. Like, and again, even if it's just for me to look at and feel good about, I appreciate it. Let me just paste this in. Okay, let's see what else is going on here. U.S. consumer confidence unexpectedly falls to 7th month low. Great. Oh boy, this is all great news. But isn't this kind of funny? Like the emotions of the market. It's just, and I've also read that September is just historically. I mean, I was investing like, I mean, not as anywhere near as seriously as I am now. But it's not like I'm new to the markets. But I mean, I'm looking at it from a much different perspective. And I know with I've gotten a lot more. I don't know, just like kind of relaxed about all the day-to-day stuff. Because it's just interesting, like how the behavior flows. But I just got a text right now from someone who used to be a mentor of mine when I worked in corporate America, who said, he said, I listened to your podcast recently and you sound great, son. So this is my ego is getting boosted right now. This is awesome. But anyway, what were we saying? So, looking at like September is typically a sell-off month. And one of the reasons, and again, it's never just one thing, but think about all the asset managers who, they've had a really great year with their clients, I'm sure. Like if they've been sensible, they've had great returns. And you don't want to finish the year like taking some unnecessary risk, because as a lot of investors do, they'll just compare results with their friends on a 1-year basis, which is really unfair. But that's just something that would, if I was a asset manager, I would be reducing some of the risk. So that's another reason that I think some of this sell-off stuff happens. There's a tendency psychologically for us to just assume it's one or two things, but there's so many different factors at play. We just tend to see like, oh, it's like the Fed just announced this and consumer sentiment is low or whatever. And then it's like, that's what's causing it. But it's, it's a combination of hundreds, maybe thousands of different things. Some are obviously weighted more than others. But Greg asked me, do you look at sentiment analysis? I don't. Just because I mean, at one point in my life, I'm sure I did, but I've just been able to tune out a lot of that stuff because I've, adopted this, the compound money quietly mantra, which is, that's what I'm trying to do. I'm trying to build I'm the engineer of my own compounding machine. And my goal is to make my money grow at the best rate of return for as long as possible, uninterrupted. And, that depends on, one of the things it depends on is that I stay long-term oriented. And so I'm not buying things that I'm worried that they'll be affected by some sort of like short-term sentiment. And if they are, then I know the business well enough, or it's a passive index fund where I'm not overly fazed by it. And that didn't happen overnight, by the way. Like I didn't just roll out of bed and be like, I can deal with the ups and downs. I mean, this was something I had to kind of condition to myself. And I've shared this before if you're new to these live sessions, but learning, not just learning psychology, but getting down to like, okay, what is this thing that I'm feeling? How does this align with what has been studied in behavioral finance? And how can I best understand like why it is that I'm feeling what I'm feeling, so I can realize in real time that it's irrational? That's been really useful for me. That's kept me from doing stupid things. Not all the time, but it's helped me avoid a lot of folly, as Charlie Munger would say. And then I also like studying the mistakes, and a lot of the mistakes are psychological. That's a great question. So Greg asks, what are the top 3 things that you've learned through your own experience and your investing journey? Someone asked me that recently, or yesterday actually, and I thought they were like, you should make that a podcast. And I thought that was a great idea. I'll take a stab at it right now. I mean, top 3 things. I think we have, there's so much. Biggest thing I think is how to look at risk. I think I credit Howard Marks with that, and then I also credit some to Warren Buffett and Charlie Munger. But Howard Marks, put me onto the idea that you don't see the risk when you have something that turns out it works out for you. There's the risk you don't see, or you couldn't see, which is like the potential chance for a negative outcome. And how when you have that chart where it's like risk reward. Typically, people look at the positive outcomes only, like the range of positive outcomes gets greater as there's more risk, but so does the range of negative outcomes. And so that's helped me, I think, just realize when I might have been taking on more risk than I realized. And I think that's a really important thing to kind of get our heads around, because you can do that unintentionally. It's very easy to do. And to give you an example, there are plenty of stories of people who, this is extreme, but let's go extreme. Enron. So you had folks who, it's not their fault, by the way. I feel terrible for these people, but, they had all their retirement in like Enron stock, and they worked there. So if you lose your job because the company goes out of business, you also, your retirement goes to zero. And I want to say it was one of the Koch brothers. This is a long time ago, maybe 5 years ago, on a YouTube video. He was talking about I want to say his grandfather or someone who worked at Ford and also owned Ford stock, and just how, like, without realizing it, they were taking on a lot more risk. And I think that's something that, again, has been really useful to me. Is just helped me see a potential blind spot that I'm glad I'm aware of now. The other idea, I think, another big one is just the basics of probabilities. That's something that you learn it in school, but you don't really learn it to use it. And all the evidence is that our brains we're just not good at probabilities naturally. We have to kind of work on it. And when you look at investing from that lens, it keeps you humble, because the probability of picking like one winner after the next, that's a tough game. And I think also too, from looking at something like expected value analysis and just trying to say, okay, like how can I weigh this decision in the most rational way possible? But let's take it a step back even farther. I'm trying to think something that's a little bit more like, earlier in the journey. Definitely. And I'm doing a podcast about this, the idea of second level thinking from Howard Marks, which in part is like, Charlie Munger was actually mentioned in the original memo from 2009, where Charlie Munger said, it's not easy. Anyone that thinks it's easy is stupid. And so Howard Marks details how, what kind of thinking do you have to have in order to have superior returns over a long time period, to beat the market, every year after year after year after year, which is, by the way, none of us should really attempt to do. But the idea that you need to have insights that others don't have, and you have to go against the consensus, but be right. And what I liked about this idea is that when you talk about you're dealing with the reality of you're dealing with the problem that we actually have to deal with as investors. If you're trying to beat the market, you have to do it by going against what everyone's saying is like the thing and be right. And that's not something that, you could easily just be a contrarian, but to actually do it and have a certain level of certainty in your decision-making and your process, and then be able to have that process work for you on average over a long time period. It's not easy to be a great investor. It's not easy to be a great stock picker long term. It's why the majority of us, and I say this not because we're not capable, but because if you're not doing it 6 days a week, maybe 7 days a week, how are you going to compete with someone who is, right? Like, that's where our overconfidence comes in. Like, what I do professionally, like, I don't think anybody's going to beat me at it. I think I've worked too hard. I've done it for too long, and I enjoy it too much. And I enjoyed this a lot as well, but I'm not kidding myself that this is all that I'm doing. I would like to do it more and more. It's a lot of fun. I love just the thinking exercise of it. But, it's just, again, our overconfidence is a killer. So, and then anything from behavioral finance, I think that's just, or, behavioral economics, depending on how you want to call it. I just find that stuff fascinating because, there's a few kind of root causes of a lot of irrational things that we do as investors, and that's what interrupts the compounding process. And that's the antithesis of what we want to do if we want to, build wealth long term, generational wealth. So Greg asks, got to read Howard Marks stuff again. Thanks, man. Any episode or post which would be good to look deeper into the probability subject? Yes. Let me get you a link. There was a episode. It was about Warren Buffett's, I'll get it for you right now. How Warren Buffett picks winning stocks. And I just randomly, I'm going to paste it in here. I randomly came across this, reading the Berkshire Letters. And it was just like a perfectly worded, like 400 words. And as I went through and read it, I then was able to attach it to say what he's talking about is probabilistic thinking. And I'll give you guys an example. So, the way that Warren and Charlie approach buying businesses is, they start off with what they can understand. And that's, again, eliminating the overconfidence, looking at, just recognizing there's limits to what we can all be experts at and have that kind of insight or second level thinking about. Then they're trying to see, okay, where among these businesses, where do we feel like we can have some sort of certainty about what the future earnings will be 5, 10, maybe even 15 years out, how certain are we that they're going to continue to grow? And that's not easy to do for many businesses, right? Because you are making a prediction about an uncertain future, or an inference, I should say. And then, from that standpoint, they need to look at they want to see, okay, do we have a margin of safety? So can we get this at a reasonable price? Is this something that, if the market tanks and, things kind of correct, we're not in a really bad spot because we, over leverage ourselves, not necessarily leverage, but just, bought something at a high, like they're getting at least a fair price. And then the concept after that, though, I think it's going down. I feel like I'm missing one thing, but this is the last one. So is there a durable competitive advantage? And one of the reasons that's so important is because if you're going to make any sort of guess about what the future earnings are going to be, if they have a lot of competition or there's a lot of potential competition, that's going to be something where that prediction about the earnings is going to be compromised just by nature. So that's one of the reasons they've avoided a lot of the high tech stocks, because those are such fast changing industries and they're also very easily disrupted. So I think that's just, there's some more in the episode about that. But so one thing that's great with doing these episodes is I retain it. And again, it's an exercise in probabilities. So they're narrowing the field. And I use this analogy in the episode about if you're taking a multiple choice test, you want to have, you might come across questions where you're like, I have no idea, right? Like A, B, C, D, E, you're like, I have no clue. But it helps if you just eliminate what you're for sure is wrong, right? Like if you can find one or two that you're like, I don't know the answer, but I know these two are wrong. Well, you just increase the probability of guessing the winner. Now, you don't want to be guessing on your investments, but you get the idea. Like narrowing the field down is really important. I think the easy mistake to make is like getting excited about biotech or something that, realistically, unless you're in the space or you're studying it, I have friends that are investment bankers and analysts and all these different roles where they're like the research they're doing within like a niche of a niche. I mean, it's so beyond what we have time to do. So that's who you're competing with. All right, let me see. The Great Shank says, I'm searching for Charlie Munger On Success book, but not able to find it. Can you? I don't know about On Success. Is there a book called On Success? I don't know about that. Vikal says, thoughts on permanent work from home when things are normal. I don't think that's going to be something that, I think the companies that will be able to have people together are going to be at an advantage. I think that we can do a lot with Zoom, but there's something with teamwork and camaraderie and just the sense of like, we're social beings. And I think, the metaverse and all this stuff, it's really exciting, but there's something about having that in-person, like it'd be like a basketball team that didn't get to actually practice together. They're going to lack a little chemistry, and someone who has that chemistry is going to have an edge. I mean, that to me is more of like, I can't prove that, right? Because there's not a study that could compare the two, but I'd wager a good amount of money that would be the case. Work from home is, think if the pandemic had happened like 10 years ago, right? Like it would have been game over. What would we have, I guess there'd be Skype and stuff, but it wasn't, it would not be, I'm sure we would have adapted, but, you just look at, not that it was, I'm not happy that the pandemic happened at all, but, it kind of, thankfully we had the infrastructure in place and the technology in place to like kind of make it work. But I'm over the whole work from home thing. I enjoy going into the office and, I like being around people. Gam hers too says your daily routine, sir. I'm like a Warren. I love saying this. I'm like Warren Buffett. Warren Buffett doesn't have. He has an unstructured schedule. That's how I have my schedule. There's things I have to do, and I have on my schedule. But I really prefer to be able to, focus on what I want to focus on, and not like have to stop and do like 15 phone calls. Sometimes that's inevitable, and I can't get around it. But I like to be able to, to kind of flow, creatively and analytically, kind of in harmony. I know that sounding like I'm like and metaphysically, biologically, spiritually. Greg says, what do you think about the e-com sector? Any example of a good stock in this segment? I've talked a lot about Chewy. I got out of Chewy not because it's a bad company, but because I felt like I'd done unnecessarily well, like relative to, I think it doubled in a year or something. And I think there's plenty of room for things to correct a little bit because it's a bit of a story stock. And I just had other ideas with what I wanted to do with the capital. I'm trying to, get out of individual positions a little bit. And, but I think Chewy's an awesome company, and I think that they are, I look, they're a leader in an excellent space. There's a large addressable market. It's growing. They have a great. I really am a customer, which doesn't mean that's why I bought the stock, but you just dig through their 10K a little bit, read the earnings calls. Like it's a pretty well run organization. Then there's always the risk of like, well, Amazon getting into pets, but there's been examples of it. You can exist in a niche. If you look at in an ecosystem, there are some animals or some species that can just carve out a niche and be really and thrive. And that's how I look at Chewy, except they have a lot of upside. I agree the founder should be principled and honest for sure. It's always, and again, not financial advice. I just have to say that because everyone else does, right? So I'm just following the crowd. Not financial advice, guys. Like you guys are just buying stocks. I'm like, well, he said to do it. Well, look, I want to call out something. I'm going to paste this in here. So I've been in my limited free time trying to upload stuff, getting like a little groove on our YouTube channel. Because YouTube is like for us to spread this Munger stuff, which I think is important, and I enjoy doing it. There is we have to be on YouTube, and so I just pasted it in there. If anyone wants, if you get in there, subscribe to it, check out some videos, give them a thumbs up. If you have a second, I mean, there's good content. I'm not telling you to go like a bunch of junk, but I think that's going to be an interesting space for us to reach a lot more people, and not just to like about Charlie Munger, but also bring people to the podcast. And I'm excited to kind of like try to take some of these back and forth and turn them into, little clips to put up there. I'm not trying to be like some influencer, but, I've gotten feedback that like, hey, like, can you post that? So I'm just trying to, give you guys what you like. And, it's a big idea that really works. The reciprocal relationship. And I'm also thinking doing more episodes as they, organically about the models. If a call says YouTube Shorts are great for reaching more audience, I should slow down. YouTube Shorts are great for reaching more audience, for sure. And I've also been playing a little bit with the Reels on Instagram. The thing I like with YouTube more, though, is it feels like they have more longevity. With Instagram, everything I put up there, it feels like it's only for that moment. So if let's say I put up a post and it mentions the podcast, because I'm not doing it's all organic. If I do that, then like I have to keep feeding it every single day. And with YouTube, there's things that can have a little bit more of a runway, where it has, a little bit more staying power. And I like that. And I think also too, it's just that you have to be there. I mean, there's just no way around it. And I also like that's a place where I think in the next 5 years, regardless of where this goes or anything, I think just being able to communicate what you're into in this format is really important. So it's almost like it's a good skill to build up. That's how I look at these lives, right? Like I think during the pandemic, I did a Facebook Live just with friends. It wasn't about investing. It was just more, I think it was about the election. And, but I had that same thought, like this is something that you want to be able to communicate your ideas this way. And I'm always getting better. It's like practice for me too. So, because I want the podcast to keep getting better. I know that's the formula. You just got to really be into it and keep doing it. But the fun part is making the thumbnails. I made some ridiculous ones, just experimenting. But all right. Anything else? Let's see. There's a question here. Let me make sure I get to everyone's questions. Perez says, how much time one should spend on technical and fundamental analysis? I can't put a time on it for you. I think you have to do what's your process and what feels right. I think if you're looking for a time limit, you're looking for the wrong thing. I say that respectfully. I'm not trying to, make you feel bad. But at the end of the day, you have to be confident in your decision. And if someone says, hey, you should make sure you're spending this much time, it should almost feel like you're lost in time. Like you're doing it and you're, oh my God, I can't believe all that time went by because you're into it. I think if you're just doing it and you're trying to find something to make money, I don't think you're going to find something that's that great. That's just my thought. Sorry if I'm saying your name wrong. Rishi Sharma 28 says, should we have international stocks in our portfolio? Again, I'm not investing in advice here. Do your research, do what's best for you. I don't necessarily agree that you need to have international exposure. I think there's enough. I'm in America, right? Like I'm in the United States. So I look at, there's a lot of the companies here they have an international presence. So in a way I'm getting exposure just by investing in those companies. So that's just my thoughts though. But I don't like the like emerging market stuff because it always has a high expense ratio, and I just think it's more of a sales, like a product to sell, than it is like a great idea. I think you do it by opportunity cost. If you think there's something going on internationally that you want to take part in, then by all means do it. But don't do it just because it's like, oh, I should have like 20% international. You know what I mean? I think that's like a very, I don't think that is I think that's the conventional wisdom, but I don't think it's right. Ryan_Go says, does the pullback in China currently present itself as a good buying opportunity? I think it really depends on what you're looking, like what companies you're looking at. I don't know enough about companies in China to be really confident in that, in that right now. I've owned Alibaba for a long time, and right now it's taking a beating. But it is what it is. I think long term it'll sort itself out, but I could be wrong too. But I do want to be more well versed in what's going on in China, because I did hear Charlie Munger a few years back say, like either buy Costco or look in China, because it's like, you want to fish where the fish are, and there's a lot of great companies there that are far less overvalued than they are here, according to Charlie Munger. I have to get out of here soon, guys, because I got to get back to the office and get back to work. But I'm going to try to get a new podcast up tonight about Howard Marks and second level thinking. I will try to put this up as a podcast as well. Just, I'm going to do a little post production to make sure we cut out some of the empty spaces. But we want to look. This podcast is catching steam. Obviously, the page is great, and I'm really excited that we're just kind of all in this snowball together. So appreciate you guys and everyone, not just guys, everyone, supporting and just, letting people know about it, being part of it, leaving reviews, all that stuff. This is just, it's pretty cool. This is all organic. So definitely great to, all be connected and try to be rational investors and just, good Charlie Munger-like people. So if anything else comes up, though, let me know, and I'll try to keep doing these. As long as you guys find them of value, I'll keep making these lives, and I feel like it's good. It's good practice for the podcast. I want to, I feel like it'd be so much harder to start a podcast in 5 years from now. So I want to really be like, I don't do stuff to do it halfway. I go all in. So I want to make sure that I exhaust myself in trying to be the best at communicating this kind of information. So appreciate it, everyone. I really do. So on that note, have a great rest of the day. Let's talk soon.
This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.